Did you see what Bitcoin just did? A brutal 6% slide followed by an almost identical pump straight back up. Most people look at that and panic. But while everyone panicked, the biggest banks and asset managers quietly made their move. And that's where the real hope begins.
Welcome to 1% BTC. That was David, and I'm Dominic. And in today's session, we're going to be looking straight into those reasons that have meant that Bitcoin's price came back up. So, quick disclaimer, we are not financial advisors. Investing in Bitcoin and any digital asset is extremely risky. Please consult a fiduciary before making any financial, legal, tax, or investment decisions. We try our best to provide a balanced view, but our models and our opinions can be wrong or outdated. So please, as always, do your own research. Now, as we've spoken about before, we've been developing a model that helps you tell the difference between two opposing forces. The first one is narrative, what you hear the media say. But obviously that's full of fear, greed, incentives, noise, subjectivity, and bias. We want to get rid of that and give you the reality. And that's why we've developed the Bitcoin reality scoring model. It takes away all of that and gives you with the cold, hard truths, the facts, the figures, the metrics, the data, objectivity, the things that you need in order to do your own research. So the first story of today, JP Morgan files new Bitcoin linked note via BlackRock iShares ETF. So what's the narrative? You see a big headline like this, and what's the narrative saying to you? Well, it makes you think that a century-old banking giant is reversing course and embracing Bitcoin. The leveraged note that they're offering promises outside returns, 1.5x gains. So if Bitcoin goes up by 100%, then the value of this note goes up by 150%. So this plays on your greed and fear of missing out for investors, really plays into that FOMO. The move signals that Bitcoin is becoming a mainstream asset. Now, the key reasons this narrative impact is so strong is because JP Morgan's name carries immense institutional weight. Its endorsement, as most headlines would have you believe, reads as a stamp of approval. The structure being tied to BlackRock's IBIT, which is now one of the most successful ETFs of all time, makes it safer than if it was linked to raw Bitcoin and raw crypto. The note payoff structure, which is capable of the big upside as I've described, also has some downside protection. This alone is very psychologically appealing to TradFi. So you read a headline like this, and it seems like something that you should really be paying attention to. But what are the facts? Well, it's true. JPM did file a structured note tied to IBIT. The note does offer 1.5x gains if and only if certain targets are met, however. The note targets maturity or a call by December 2026, or here's the interesting thing, by 2028 if targets are not met. So there's partial downside protection. So the principal is preserved if IBIT doesn't fall over 40%. If IBIT exceeds the preset price by December 2026, the note pays a minimum of 16% return. Yeah, which gives that downside protection. The product is therefore marketed as aligned with Bitcoin's next halving cycle, which is extremely interesting considering that JP Morgan have been notoriously against Bitcoin. But here's some of the downside. Leverage ETF exposure rather than direct custody. It's not like JP Morgan are attempting to launch their own ETF or a similar product. They're going straight for the leverage products. It was filed just days after JP Morgan had taken a very critical tone towards certain crypto firms, things like MicroStrategy and specifically Jack Mallers. Users of the note also risk significant losses if Bitcoin, and therefore IBIT, falls substantially. It's explicit in the docs. So this is aimed at investors who prefer regulated financial products over crypto wallets. So the filing is public. Its mechanics are plausible under the existing financial regulations, which means that it's likely to go ahead. And the leverage plus structured notes are well understood within the TradFi space, which means the execution is technically feasible. Really adds credence to this story. But overall, and here's the thing to bear in mind, the volatility and Bitcoin's price risk remain, making the outcome uncertain, especially over a longer time frame like 2 to 3 years. So although this headline might blow you away, it might not be as good or as groundbreaking as you think. So what's the summary? Well, the narrative, as I said, would have you believe that the legacy banking giant is embracing Bitcoin. It's offering leveraged returns through a regulated product, and many would take this as signaling a new wave of mainstream crypto acceptance. But as we've just seen, there are some downsides with it. So yeah, the filing's real, the structure is regulatory compliant, and the underlying ETF is established. But the note carries real downside risk and depends on future Bitcoin price behavior. So how bad or good could this get if it plays out? Well, it is a credible institutional experiment and an incremental adoption pathway. Not a guaranteed boom, as the headlines would have you believe, but it is still a noticeable and noteworthy story. So overall, the upside potential of this story is a 4.6 out of 10. That is good. But right now, we're sitting at a 3.1. Because mainly the leverage plus asset volatility adds risk. The second is that there's a risk that their clients are risk averse to volatility and just don't use the product. Uptake for these leveraged products generally takes longer than normal ETFs, so the timelines may take longer than expected. The leverage, as I said, does amplify the downsides, and any type of product like this you see from Wall Street may increase centralization. So, final score is a 3.1 out of 10. It introduces a regulated channel for institutional Bitcoin exposure, but outcomes remain uncertain. Upside absorbed by risk and volatility, and could matter in 1 to 5 years only if it's broadly adopted. So
this really seems like such a contradiction in a news item, because what's really helpful is your final score actually recalibrates it to reality, right? Because at first, when you read the headlines, it's very much bullish, right? Then when you get into it, it's actually it's a leveraged product, which is quite risky, right? Even though the downside is protected, it's still telling people that, you know what, you're still kind of at risk. This is still a risky product, and it could really not work out well for you in the end. But so I like your kind of the way you describe the negatives to consider with the bullish news.
Correct. And yeah, thanks, David. And as I said, if we start to see increased demand and increased usage of this product, of course, that's going to improve the score that this model is currently giving it. Any score that we put into this model, if we feel that the news story is worth monitoring, will be tracked in perpetuity until that story is obviously closed. This is one that we are going to keep an eye on. At the moment, it's scoring a 3.1 because of those negatives that you've mentioned, I've mentioned. But obviously, it could go higher. Now, in terms of what to watch out for to see if we start to see some real benefits from this story, obviously demand for the note, the issuance size, and obviously if there are any competitor products launched. So JP Morgan, as I said, historically has kept Bitcoin at arm's length. They're still doing that. This product doesn't imply to me in any way that they've changed their tone, at least not publicly. What it does indicate, however, to other institutional players is they're not going to sit on the sidelines anymore. They want to be involved. So therefore, if I were one of their competitors, I would be seriously considering putting out similar products. So that's something to watch out for. So the next story, Bank of America recommends 1 to 4% crypto allocation. Now, obviously, this seems like a really bullish headline. So one of the world's largest banks is officially endorsing crypto allocation. This makes it seem like there's a psychological earthquake going on within TradFi. The 1% to 4% recommendation signals crypto is now part of a normal portfolio. So I would read this and I would assume that in many ways it's legitimized Bitcoin and certain other cryptos in the traditional TradFi environment. It also implies therefore that there's a turning point going on. Big banks are no longer going to resist crypto, but they're actually proactively going to guide clients into it. So the key reasons that this narrative has weight and why it sticks with people, like we call it the stickiness of a narrative, is that Bank of America has, like JP Morgan, historically resisted crypto exposure. So this reversal, on the face of it, does seem extremely dramatic. Now, their wealth advisors, and there's around 15,000 of them from what I can tell, are now allowed to recommend it. So that is good. So so it's not just respond to client requests anymore. And the announcement fits into a broader institutional wave, like we've just seen with the JP Morgan story. The big players are making moves. We can see it. But what's the actual reality? Well, the 1.1 to 4% allocation was confirmed. The guidance is official. They are going out to clients. It was explicitly quoted by Bank of America's CIO. The January ETF coverage list creates a regulated pathway, and those ETFs that will be include IBIT, FBTC, which is Fidelity's product, BITB, which is Bitwise's product, and surprisingly for me, GBTC.
Mm.
So the move follows identical guidance from Morgan Stanley a couple of months ago, and the guidance, as I said, is targeted at Bank of America's wealth clients, and it applies specifically across Merrill Private Bank and Merrill Edge. Now, here's one of the things to watch out for. The advisors, just remember, previously could not recommend crypto. They could only do so if there are. So this is a big turning point compared to that. So the 4 ETFs receive, in a way, Bank of America's CIO coverage beginning January 5th, 2026. So the news that it's not actively happening yet, but from January 5th, 2026, less than a month, around a month's time, that's when it will kick in. So what's interesting also is that their client demand was actually cited as a primary motivator for them to do it, which I find really interesting, because what it shows is that you can try and resist Bitcoin as much as you want, but even if you don't agree with it, some of your clients will, and they will eventually, those who want it enough, will pick up and leave and take their business somewhere else. And it's interesting to see that Bank of America have actually recognized this.
Yeah, that's similar to JP Morgan, right? Where they were very vocal to say, we don't recommend, we don't support, we'll never do it. But then in the end, it's client demand that always pushes them and says, you know what, you're going to need to pay attention to this because we're going to leave banks.
Absolutely. Absolutely. So same thing with the JP Morgan. It aligns with a rising institutional flows into regulated crypto vehicles. Despite the recent selling over the past month and a half within the Bitcoin ETFs, we have started to see inflows returning. So it does represent a policy shift from restricted access to proactive allocation. So that's what I want you to take away from it. It's not that Bank of America are doing something completely brand new. They have, when asked, been able to recommend these products. But the difference is they've now turned into salesmen. They're turning on the salesman sprig, and they're going out there, and they can now proactively contact their clients and actually offer them to tell them more about these Bitcoin products. So where does this end up with the score? Now, you might notice that the narrative score, whereas it was a 9.5 for JP Morgan, it's only an 8 here. Now, the reason for that is the JP Morgan captures headlines, especially within the traditional market / Bitcoin space, more than Bank of America. JP Morgan is the archetype villain amongst many Bitcoiners and crypto holders. And so any of those headlines that show JP Morgan turning around tend to have more narrative. But remember, narratives are short to medium term. Yeah, they don't stretch over the long term, which is why we've developed this tool. So what's the narrative saying for this? The narrative would have you believe that Bank of America is finally endorsing Bitcoin as a normal portfolio asset. But the reality is that the shift, although the shift is real, it doesn't begin until January 5th. And it aligns with some other banks. So the allocations remain small and must pass internal compliance friction. So it's not like they're going out there, even after all of this, even after all this pressure, and going and saying, hey, we recommend a 40% allocation to Bitcoin products because of their performance over the past few years. Instead, they're keeping it very, very small. So we've got to tone down, the reality is toning down that narrative. But overall, in terms of how big this story could get, I don't want to break this down, but it is a strong structural adoption. It is a milestone with durable effects. The advisor-led flows, the normalized exposure, and long-term demand reinforcement really will help layer this story down over the long term. In terms of some of the downsides to this, obviously, we got to just bring it back to reality. It's focused at wealth clients, and those same wealth clients may treat crypto as a theme rather than a long-term reserve asset. So they may deploy a percent just to be involved, but once again, it might not. They might not increase that over time. There is that risk. The ETF gatekeeping obviously keeps users away from self-custody, something we don't like within the Bitcoin space. Allocation ceilings remain small, as I've said, and risk teams may apply friction. So if for whatever reason these risk teams get scared, they may advise their clients to downsize their portfolio allocations. Say someone's gone for 4%, they may suggest actually decrease it. So
Right.
yeah, that is a risk. So we've really got to temper this story. But even so, it is a 3.1. The strongest US bank-driven catalyst since BlackRock's IBIT breakout. And we believe, or the tool believes, that this shift will still matter in 1 to 5 years, which is why it's scored a 3.1.
What I really like about this story is it's very aligned with our channel principle of 1%, right? It marks a major shift from just not recommending to, you know what, we are recommending. We're starting out small. 1 to 4% is relatively small, but that's just it. It's this introduction to this asset class within the kind of regulatory framework of a big bank, one of the America's biggest banks, right? So it's quite good. But 3.1 out of 10 is still positive, still quite good. But compared to an 8, which is the narrative that it comes out, that's quite a jump down.
It really is. It really is. And you raise a good point. I think what the tools picked up on is that despite all of this, the likelihood that Bank of America's allocation guidance of 1 to 4% is actually translated into real client allocations and continued advisor behavior to continue to recommend these, and obviously therefore increased ETF flows, remains to be seen.
Yeah.
We don't know that for a fact. So that's why the probability here isn't high, it's medium. So that 6.6 score, in terms of if that trend does translate into increased ETF inflows, of a 6.6, which will obviously be really good, it's downgraded it to a 3.1 because we just can't confirm. We can project, but once again, that would be myself and David trying to estimate the best case scenario. We want to take that out of the ring. So what to look out for? The advisor ETF flows. Obviously, monitor the ETF flows, see if you notice any marked change, any allocation changes. So are we seeing sort of hearing words of big clients moving significant amounts into Bitcoin ETF products from within Bank of America? And also any policy changes. So obviously the environment in crypto has historically been harsh towards Bitcoin. However, although we're seeing the current regulatory environment open up, there could be policy changes which do dampen this and temper it down. So those would be 3 things to watch. So the next story, Vanguard opens platform to crypto ETFs. Now, this was one that instantly caught David's eye because the psychological impact this has is that Vanguard, who, like JP Morgan, like Bank of America, have explicitly said they will never invest in Bitcoin and never do recommend any Bitcoin related products, have now basically agreed that they will list these things on the platform. So it's the article implies that they're capitulating, and this really provides psychological fuel for global retail markets. People like myself and David would read this and interpret it as this is really the turning point in things, mainly because they have over 50 million clients worldwide. And so just seeing anything like that, as it's called out in this headline, is a really monster headline. It's seen as a direct follow-up, obviously, to BlackRock and Fidelity's ETF expansion. So obviously Vanguard chose to fight it, but now they're really coming around. And most importantly, the tool picked up that it comes just after the price drawdown. So it also impresses that there's narrative resilience and inevitability in Bitcoin, because Vanguard aren't stupid. They know when they're timing these communications. So for them to launch it now while the price has dropped, as opposed to when the price is at an all-time high, obviously adds to that narrative boost.
What's the reason why this is quite interesting is because when the Bitcoin spot ETF was originally announced in January of 2024, so we're about 2 years late, right, to the game. I was shocked that they didn't. Initially, when it was launched, you had about 10 or 11 firms, the biggest firms that are launching this ETF, but Vanguard specifically said, no, we will never provide that, and we will stay away from Bitcoin, recommending Bitcoin to our clients. But this is a huge shift. Even though it's 2 years late, it's quite good news for kind of also the smaller investors too. This is like retail investors and people wanting to get into, very index trackers and these types of kind of low fee products.
That's it. I mean, as the same with Bank of America, if you wanted access to ETF products before, specifically with Vanguard, you would have had to basically change your asset manager. You would have had to switch from Vanguard to BlackRock. And I think that we know for a fact that has happened before to Vanguard. We don't necessarily have reliable sources on what sizes, but we do know that has been part of the incentive for Vanguard to switch. In terms of the reality of this, what do we actually know? So we know that the policy has been confirmed by Bloomberg and Yahoo, which are both credible sources. So that really adds credence to this story. So that part is true. There are also quotes from executives at Vanguard, which are obviously highly credible. There's a concrete launch date, which and not just vague guidance, which is obviously Tuesday, the 2nd of the 12th, and the ETF structures already shown to perform through volatility. So their ETF offerings will cover Bitcoin, Ether, XRP, Solana ETFs. As I said, it will open it up to 15 million retail clients will gain access. Vanguard is a huge deal. They manage $11 trillion worth of assets under management, and this is a capitulation. So the tool even understands that this, or believes that the narrative is right. They have capitulated. So the ETFs have performed throughout the volatility, as I just said. There is administrative support systems are now mature so that they can actually offer these products reliably. And what's really interesting is, and I picked up on this months ago, is that the current CEO of Vanguard is pro-blockchain, and he formerly worked at BlackRock. And the reason that it was pretty obvious that Vanguard would capitulate and they would end up launching enabling products like this on their platform is because their CEO was part of the team or spearheaded the team that launched IBIT at BlackRock. Now, in terms of the downside here, I just want to point out one thing, which is that we are not saying that Vanguard will launch their own crypto products, at least not yet. Now, that would be better because obviously there'd be more diversification amongst these big holders. Currently, a lot of the Bitcoin is centralized within BlackRock. So it would have been good to see them actually go a bit further and launch their own products. I think that would be a full 180 turn. But obviously, this is still a really positive thing. And one really great thing that I liked was they've still actually banned meme coin ETFs. So they're not going that far. I mean, I personally don't like the fact that they're offering certain other ETFs like XRP, but I do like the fact that they haven't actually, they're still not permitting meme coin ETFs. So it does show capitulation, but specifically around the more reputable cryptocurrencies. So let's have a look at the narrative summary. So the narrative wasn't as strong for this for Vanguard, mainly because a lot of people in the industry don't actually, specifically the Bitcoin industry, aren't actually don't put that much emphasis on Vanguard because they have stayed out of the game so much. They're not constantly in headlines with regards to crypto. They choose their wording very carefully. But even so, the narrative is still pretty strong with this. And the real thing that the narrative is trying to push is that one of the last major anti-crypto giants has finally capitulated. Now, the idea that they're now giving 50 million customers access to regulated crypto ETFs. So what's the reality? Although the policy shift is real, they're only enabling SEC-approved ETFs for now. So no meme coin exposure, which I said I like. That may sound like I said that was a good thing, but as you notice, the score's gone down. And that's because obviously we would like it if they offered products specifically tailored to Bitcoin directly, as opposed to through the ETFs. And also it's tailored down because Vanguard will not launch their own crypto products yet. So in terms of how good this could get or bad, the institutional barriers against Bitcoin are failing. The ETF infrastructure continues to dominate US crypto adoption, and Vanguard's reversal cements Bitcoin's long-term integration into the mainstream financial architecture. So this is a really, really good sign. In terms of the probability, so Vanguard's 50 million users meaningfully expand the addressable base. There is institutional adoption trend is durable. It does withstand the test of time, and this kind of proves that. The ETF infrastructure performs reliably in volatility. So the fact that, as I said, they've announced this while the price of Bitcoin has been down shows that there is a level of conviction. There's low regulatory friction because obviously they're not creating new products. They're just basically enabling existing products within their platform, which means that this will very, very likely go ahead. And there's a massive symbolic legitimacy blow in Bitcoin's favor. In terms of some of the downsides, however, the limited product scope does reduce the magnitude of adoption. This could also concentrate flows in existing ETFs, something which we don't like. And there is political and regulatory swings, which remain a risk for all US products. So that does go obviously for Bank of America, but also for these. So overall, long-term, this is a major long-term positive catalyst. And because of the launch happening very, very quickly, and because of the narrative, here's one of the few occasions where the actual long-term benefits do outweigh the narrative. It's actually stronger than the narrative. It's going to have meaningful impact over the next 1 to 5 years.
That's incredible. See, I was giving a seminar on kind of education and investing in different products, and a lot of the recommendations were to a lot of the users were invested on the Vanguard platform, and the restriction was they couldn't invest previously in any crypto related products, and it was such a limiting factor in their ability to gain exposure to an asymmetric investment. And this is quite bullish. I'm really not surprised that it's rating it 6.6 out of 10. It is quite positive, especially considering their $11 trillion in assets under management. So yeah, interesting.
Well, they were the sort of the last of the sort of big four to really sort of go against Bitcoin and go against these crypto products. So to see any level of capitulation for them is why this why this score has gone so high. It will have a meaningful impact, and just the size of that customer base, whether that translates into real adoption remains to be seen. But just the size of that customer base, 50 million users worldwide, means that it is a real impactful news story. So in terms of what to watch out for, as I said, would be great if Vanguard begin issuing their own Bitcoin related products. So keep an eye on that. But also if they start to launch other products within the crypto space, so maybe Ethereum ETFs. If there are obviously a noticeable acceleration of ETF inflows from retail accounts, that will be an indicator. And also just watch for their competitors like Schwab. to see if they start making similar moves. But also look at other big players across the globe. Mainly Schwab is the one that I would be watching next. And for our final news story of the day, and I'm sure this hasn't gone without notice, this has been all over crypto Twitter, or should I say X, and it's that BlackRock's Bitcoin ETF, IBIT, which obviously we've been talking about a lot in this video, is now the company's most profitable Bitcoin profitable product, not just ETF, product. Now they have hundreds of products going out to millions of clients worldwide. BlackRock are by far the largest asset manager on the planet. So you see a headline like this, and it makes you feel like Bitcoin has definitely conquered Wall Street. It definitely makes you feel that the fact that it's become the top profit engine for the world's largest asset manager reinforces the idea that Bitcoin is inevitable. And that is definitely what I'm seeing all over crypto Twitter. The scale of the success that obviously they've seen, considering that the ETF was only launched, as David said, 2 years ago, is just phenomenal. And it really is a historic moment. So expect there to be, I would expect to see off this some short-term FOMO, which I actually think we might be seeing in the markets today. I think we've seen a slight rebound from the 6% drop that David alluded to that's happened in the past few days. So the reality, what's true in the story, the profitability numbers, so the fees, the assets under management, the inflows, are publicly documented and confirmed by executive statements. So that's all true. IBIT does now hold a staggering, and it doesn't sound like a lot, but it is a staggering more than 3% of the supply. And this is all verifiable on-chain and with fund disclosures. Now, the revenue comparison versus the S&P 500 tracker is factual and quantifiable. Now, by that, I mean, when we say that it's their most profitable product, you would expect that their S&P 500 product would far exceed the revenue from, would give far greater revenue. However, it doesn't. And the reason you would assume that it would is because, one, it's been around a lot longer. Two, it's actually included in a number of passive index funds and which are used and invested in regularly by pensions and large players. So for the fact for this to be more profitable for BlackRock than those type of products is really amazing. There is one minor constraint which we kind of touched on throughout the story, and that is obviously there are some outflows during volatility. I would put these down, and the tool has as well, to normal ETF mechanics. So yes, we have seen outflows over the past few weeks. Yeah. Do I think they'll be sustained for the long term? Maybe. Who knows? I personally don't think so. So here's some facts. IBIT, which is obviously their ATF, generated over 245 million in fees by October 2025. It's the fastest ETF in history to reach $70 billion in assets under management. It did that in less than a year, 341 days. BlackRock's internal portfolio increased IBIT stake by 14%. So yes, BlackRock is buying their own product, which I think shows you where they believe the long-term viability of Bitcoin is going. Yes, there was ETF outflows equivalent in November, equivalent to 2.34 billion, which is big and substantial. But the long-term trend is that these things are sucking up and hoovering up Bitcoin, which is why BlackRock now has over 3% of the supply. So all in all, a really, really big story. So let's just run through the narrative. Now, obviously, as I said, this has gone everywhere, all over Bitcoin Twitter. And the idea, the narratives that they're spreading is that Bitcoin has decisively conquered Wall Street. It's won. We have taken over because the incentive structure for BlackRock to now continue to promote Bitcoin and continue to earn revenue from their fees is so high. So the only limiting factor here, so the reason the score has dropped, is that the modest volatility driven by the outflows is just tempering the perfect picture. So had we not had that and this headline launched, I think it would be an entirely different story. I think that the reality would match closer to the headline. But let's not avoid the truth. Over the long term, the fact that IBIT is now the top profit engine for the largest asset manager on earth is huge institutional reinforcement. Yeah, and the competitive moat is deep. Yeah, so this really is something meaningful long term for Bitcoin. So I would put this, and the tool places this as a major institutional catalyst that meaningfully reshapes Bitcoin's structural trajectory by proving Bitcoin products can out-earn the world's most established ETFs. So even reading that, and that's tempered down, that narrative alone is going to resonate with the biggest players in the world. It really is.
Mm. Think about what this actually means in terms of numbers, right? At one time, IBIT represented about 3% of the total Bitcoin supply, right? That's just within the ETF of IBIT. That's an incredible number of adoption. And considering their fee structure is one of the lowest across all the ETFs, right? At 0.25%. Combined with its AUM, that equates to about, as you said, $245 million in annual revenues. It's a big moneymaker for BlackRock, right? So it's the most profitable ETF product to date. It's incredible.
And I think, David, and you might have a few comments on this, like the thing that we touch on, obviously, in a few of our videos, and it's kind of like a catchphrase, is game theory. So what BlackRock is proving to the world and the other big players is, hey, I can go in on this Bitcoin thing, which many of you poo-pooed, many of you shot down, many of you said was too risky, and I can show you how to meaningfully turn it into a profit-driven product, and one that over multiple years suddenly turns into your most profitable product. Think about the incentives that creates for other players like Vanguard who are watching this and seeing these headlines and thinking, we really missed the step. And I think that's why Vanguard capitulated, was because they knew this. They could see the trend. They could see that the adoption of this ETF was breaking all records for all ETFs. And they could see that the amount of revenue that it was going to generate for BlackRock. And they wanted to get in the game. They couldn't afford, well, even if they didn't want to, they were dragged kicking and screaming into the game.
Yeah,
so,
you're exactly
really
right.
Really big move.
And BlackRock did spearhead the application and the process for, I think, a big reason why all the 11 providers were approved was because BlackRock, I mean, in its history, they had one or two applications for ETFs that were denied, right? Everything else was approved. So they have 1,400 plus funds, right? That's a massive record for successful products that have been approved, that have gained regulatory approval. And so because they spearheaded it, it paved the way for all these other providers to offer it.
Really did. Now, obviously, in terms of what to watch for, whether Vanguard begins issuing its own Bitcoin or ETF product or Ethereum products, if there is an acceleration of inflows, and once again, the competitor responses. So the same thing with the Vanguard, is these big asset managers will just be watching each other like hawks, and headlines like this will catch their eye in exactly the same way that it catches the eyes of retail, in exactly the same way it will catch the eyes of big investors with accounts at these big asset managers. They will all be watching it. So on to the final scoring for today. Now, obviously, as you can see, the BlackRock story, BlackRock scored the strongest because BlackRock scored the highest. Now, it did this because the results are real, proven, and already scaling. Their Bitcoin ETF is now BlackRock's most profitable product, beating even their S&P 500 fund. The record flows, institutional buying, and internal allocations show deep structural commitment. I really want to get that across to you. And as I've said, the incentives for BlackRock and their competitors to continue to support Bitcoin's success are now massive. Why would they give up the golden goose? So in other words, real performance turns into high feasibility, turns into the highest score. And that is what we've seen with the score of 7.5. It's active, it's in motion. Now let's compare it to Bank of America. So Bank of America came in with a close second because it formalizes a major advisory shift. A recommended 1 to 4% Bitcoin allocation across Merrill, Private Bank, and Merrill Edge changes advisor behavior system-wide. Huge reach, but nevertheless, got to point out that it's still guidance. It's not a balance sheet move yet. But either way, it's a strong institutional signal, but just slightly lower than that of BlackRock's, which is why it scored lower. Personally, for David and myself, we thought that Vanguard would score higher than Bank of America. We thought it would be maybe even the biggest story, but it doesn't score higher because the move that Vanguard have made is access focused, not endorsement. When they start allowing their own crypto ETFs and start developing their own crypto ETFs, then we'll see it go up. At the moment, they're just allowing crypto ETFs after years of resistance, which, yes, is big symbolically, but there's no product launch, no recommendation, and no pro-Bitcoin positioning. So yes, it's a meaningful opening, but structurally softer than the Bank of America move. Now, JP Morgan obviously ranks the lowest because the impact is narrow and it's a product-specific headline. So the structured note, yes, it does offer 1.5 times upside via IBIT, but it's limited to one wrapper. It's not a platform-wide or policy-wide shift. JP Morgan gives access, but continues to keep crypto and specifically Bitcoin at arm's length, at least in public. So it's a niche product with the lowest structural impact and therefore the lowest score. We're not saying it's irrelevant. We're just saying that these other events are far bigger in terms of their long-term scope and longevity. So once again, what does the Bitcoin 1% BRS tool reveal? It reveals what survives when you strip away the hype and the fear and match the story to real-world facts. David, have you got any thoughts for our viewers before we let them go?
Yeah, I think a lot of the kind of the common thread within each of these really bullish stories is that these banks, these institutions are being led by client demand. Their clients are saying, hey, we want this product. You need to be offering it. If not recommending it, at least offer me the option to be able to allocate at least 1% to 4% into this emerging asset class. And that's quite powerful.
It really is. And that's exactly why we give you headlines like this, guys, because don't forget, most will miss it, most will mock it, and most will wait until it's too late. But the 1%, they're with conviction.
Be a 1%er.
Thanks, guys.
Later, folks.